Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and we are continuing with our chapter-wise revision. This is chapter number 13, Working Capital Management. So this chapter is all about working capital. How do you, what are the various approaches, how much of how much of your working capital you should finance with short-term sources, how much should be financed with long-term sources, then a cash operating cycle. So all of this is what we will study over here. Let's get started. First of all, with the definition of what is working capital. So it's nothing but the capital which is represented by your net current assets, which are there for day-to-day activities, day-to-day operations of the business. So these are net current assets. It's basically the formula that is given is that working capital is equals to current assets minus current liabilities. So you can also say this is the excess of current assets over current liabilities. Now, when I talk about working capital management, there are two main objectives. There are two main, things that we want to achieve with a good working capital management. Number one being liquidity. Number two being profitability. Liquidity means being able to pay off the current liabilities on time, business having enough cash so that it's able to pay off any, payments to suppliers that they're supposed to make, paying the salaries of employees on time. So liquidity is this, and then profitability, you all know, the ability to generate profits on the money that is invested in the business. So these are the two main objectives. Always and always, these two objectives will conflict with each other. When you try to have more liquidity, more cash with yourself, that means that cash remains idle, that is not invested anywhere, so your profitability suffers. In vice versa case, where you invest all of the cash in different investment avenues, you do not have a lot of cash to pay your liabilities on time, hence you suffer from liquidity issues. So this is why these two objectives will always conflict with each other. Now, businesses should always try to avoid the extremes, avoid extreme liquidity and avoid extreme profitability. Let's see what will happen if there is an extreme of each of these. Number one is where the business is over trading. What do you mean by over trading? Here, you do not have enough working capital to support the level of activity that you're doing. So over here, you will have a high proportion of short-term to long-term finance. So you're trying to finance most of your working capital with short-term sources of finance compared to long-term sources. You don't have that level of working capital, but you're still operating at very high levels of activity, very high levels of sales. So but you do not have the working capital to support that level of activity. Now let's also talk about how can a business improve if they are facing over trading. So improvements over here will be, number one, that the business should try to reduce the inventory holding period, both the raw materials as well as finished goods. Secondly, they can try to reduce the production period. So production period is nothing but the time it takes for the business to, once they have the raw materials, how much time are they taking to make the final product. So they should try to reduce that. They should try to also reduce their receivable collection period. This means money will come in quickly. Then they should also try to increase their payable payment period. That means money will go out slower, so more money with you in the business. Then they should try, because over here your short-term finance is more compared to long-term finance, so they should try to increase the level of long-term finance. And then last but not the least, they should try to reduce the level of sales growth to a sustainable level. Sustainable level meaning to bring your sales to a level for which you have appropriate working capital, you are not over trading. So this is how, if a company is facing overtrading, these points are something which they can follow, with which they will be able to overcome the problems, that come with overtrading. Now, another name that you should know for overtrading, that it is also called as undercapitalization. Now, what factors basically will indicate that a business, we talked about the solutions, but how do you get to know that a business is actually overtrading? So there are a few indicators through which, if you find these things in the business, that means, the business is overtrading. So what are the indicators? Number one is that there will be declining liquidity. You'll have lesser money with yourself in your hand to pay off any obligations. Number two, you will have a rapidly increasing revenue. Number three is that there will be an increase in your inventory holding period. Then your receivable days will also increase. Your short-term borrowings are going to increase. You'll have a declining cash holding. You will have a large increase in your overdraft, right? Because you're relying more on short-term sources of finance. Overdraft is one such source. Then there will be a declining profit margin. And then your ratio of sales to non-current asset, this ratio goes up. So these are a few indicators. If you see this in a business, then it will indicate that a business is actually overtrading. And I told you the other name for overtrading, which is undercapitalization. Let's now talk about the vice versa scenario. Over here, you were focusing more on your profitability. Now, in the other extreme, where you are focusing more on liquidity, that scenario will be called as overcapitalization. So this is overcapitalization. What will happen over here? Because you're focusing on excessive liquidity, you'll have an excessive level of working capital, leading to inefficiencies. Excessive working capital leading to inefficiency. Now, the next thing that you will find in this chapter are the two formulae, the classic formulae to judge liquidity. You have the current ratio. Current ratio, I'm sure you all must know, is equal to your current assets divided by current liabilities. The ideal ratio, which is given, even though it will depend from company to company, but the generalized ideal current ratio is of 2:1. And then there's another liquidity ratio which comes along with current ratio, which is known as the quick ratio. So over here, you have your quick assets in your numerator, which is nothing but your current assets minus your inventories. And the denominator remains the same, which is current liabilities. Right? So like I told you, the ideal ratio when it comes to the current ratio is actually 2:1. You'll find that the quick ratio is ideally supposed to be 1:1. Then it is said that the company has enough, quick assets to pay off their current liabilities. Now, when you talk about financing your working capital, what kind of, working capital policy you have, there are two approaches. So there are two approaches. Let's study them one by one. The first approach is the conservative approach. Now, as the name suggests, you are a conservative person. You do not like taking risks. You are a highly risk-averse person. So over here, what will be your characteristics? You have high levels of inventory. You are giving generous credit terms to customers, which means you will have high receivables terms to customers. Another characteristic is that you will be paying off your suppliers early, and you also hold a high level of precautionary cash. Precautionary cash meaning cash for emergencies. So this balance is also very high because you're a person who does not like to take risk. So you hold a lot of precautionary cash also just in case an emergency arises. Now, when you're adopting this conservative, highly risk-averse approach, there will always be some problems because extreme of anything and everything is bad. You should always try to balance things together. So the first problem that can be faced over here is inventory obsolescence, meaning that because you're keeping high levels of inventory, there is a chance that your inventory becomes obsolete. There are newer versions of the product that you sell in the market available. Because you have stocked a lot of previous stock, then there is a high risk that that becomes obsolete. Then another problem is that there will be high financing costs. Definitely money that you're keeping with yourself, you're allowing your customers to pay you after so long, and then you are paying off your suppliers early. So obviously this comes at a cost of financing. Then if we talk about the second approach is called as the aggressive approach. So this is going to be poles apart, exactly opposite from the conservative approach. Here you have a high tolerance for risk. So you will have low inventory, low receivables, and cash balance. So this is what your risky approach is looking like. Now, why is this approach risky? It's risky for three reasons. Number one, inventory may run out. Because you're keeping low inventory, maybe there's a period of high demand, so your inventory runs out. If your inventory runs out, there may be a possibility that you lose out on your sales to other competitors. Then if you talk about the receivables aspect, you can lose customers to competitors who are actually giving generous credit because you are not giving a lot of credit to them. So you may lose out on customers to competitors giving generous credit. Another problem pertaining to cash. So because you have less cash, you will be lesser able to meet unexpected expenses. Less able to meet unexpected expenses. So these are the reasons why the aggressive approach is risky, or you can also say these are the problems with the aggressive approach. Now there's a third approach called the moderate approach, which is nothing but a combination, something which falls in between your first and second approaches, which is the conservative and the aggressive approach. So here you try to have a balance between high and low levels of inventory, receivables, and payables. Now we'll talk about a few sources of finance. So how you finance your working capital, there are two sorts of sources through which you can do that. Number one being short-term sources, and number two being long-term sources. So what are the sources when you talk about short-term? Number one is overdraft. Businesses use the overdraft facility. So a few characteristics is that it is expensive but flexible. So you can take overdraft whenever you want, even though it is expensive, but it gives you the flexibility. Another characteristic is that there could be variable interest rates that the bank can charge you on the overdraft that you take. And another thing is that technically it is repayable on demand. Whenever the bank asks you to pay, you will have to pay the money back to the bank no matter what happens. Then another source when you talk about short term is the short term loans. So because these are for the short term, usually you will find low interest rates. And then there's one factor which is not good here, which is called as the renegotiation risk, which means that the bank may refuse to refinance on maturity. Let's suppose you took out a loan for 3 months, but you later realized you need it for 6 months more. So there is a risk that the bank may refuse to give you an extension of this loan for 6 more months. So this is one problem when it comes to short-term loans. Talking about the third and the last short-term source of finance, which is the accounts payable. So these are nothing but the your suppliers who are giving you credit. So this method appears cheap, but you have a risk of losing on early settlement discounts, which makes it expensive. Losing early settlement discounts. Another thing over here is that if you delay it too much, then there can be lost goodwill, or there can also be penalties for late payment. And then last but not the least, your suppliers may lose patience if you obviously are defaulting every time repeatedly, paying them after a lot of delay. So what will happen? They will probably refuse to give credit in the future. So refuse credit in the future. So these are the characteristics, all of those sources which you have for the short-term finance and a few characteristics that they have. Now coming to the long-term sources, let me change the color of my pen. So if I talk about the long-term sources, the number one that we talk about is going to be equity. So you all know equity, either new shares can be issued or retained earnings can be used to avoid issue costs. Over here, there is no legal commitment to repay, obviously, because equity is not redeemable unless the company gets wound up. So there's no commitment to repay this money that you raise by equity. And then the second long-term finance which you can use is possibly debt. With debt, you can take loan notes or bank loans. And then if your interest rates are fixed, then you have a protection against rising interest rates. So fixed interest rates give you protection against rising interest rates. So with this, we are done with the long-term and short-term sources of finance. Now moving ahead to, there are two types of current assets that a business can hold. The first one being permanent and the second one being fluctuating. So when you talk about your permanent current assets, you will primarily be, thinking about some assets which are more permanent than the others. So always and always business will hold buffer cash, some extra, cash. This is also called as precautionary cash. Businesses will always be holding some amount of buffer inventory. And then last but not the least, your businesses will always be holding a minimum trade receivables. Your total will fluctuate above the minimum permanent level. So basically, if my receivables throughout the year, let's suppose at different quarters, let's talk about March, June, September, and December. So if I see my receivables in March, I have 20. In June, I have 35. In September, I have 15. And in December, I have, let's suppose, 20 again. So if you see, 15 is the minimum that it gets to. It's in all of the periods, it's more than 15. So this 15 will be called as your permanent current asset, and anything which over and above 15 which keeps on fluctuating will be classified as your fluctuating asset. So this one, holding of minimum trade receivables, all these three assets that I've listed here will fall under the category of your permanent current assets. Now, earlier we spoke about what your, whatever the different approaches are with respect to how much inventory, receivables, and payables, basically how much will be the amount of your working capital. Now, let's talk about the financing strategies. So, how can a business actually finance their working capital? Financing working capital. So ideally, there should be a matching policy which should be followed, because permanent assets, permanent current assets stay with the company for a longer period of time. They should be financed with the long-term sources of finance, and the fluctuating ones, because they keep on changing, they can be financed via short-term sources of finance. Now let's talk about a few approaches which you would see companies adopting to finance their working capital. Number one over here being the aggressive approach, similar to what we studied earlier. This is the person who takes a lot of risk. So in the aggressive strategy, they will definitely be using short-term finance for fluctuating assets, but they will also use short-term finance to finance, if not all, some permanent assets. So short-term will be used for fluctuating plus some or all permanent assets. So over here, this strategy will be cheap because short-term source of finance is cheap, but there will be a high risk. High risk again because you are financing something which stays with you for a longer period of time through short-term sources of finance. So the maturity are not matching. Then talking about the second approach, which is called as the conservative approach. Here, what do we do? Long-term finance ideally should be used for long-term sources. So this will be there, plus some or all of your fluctuating assets will also be financed via long-term sources of finance. So all of your fluctuating, all of your permanent plus some or all of fluctuating assets. So this is how conservative financing working capital looks like. Then if I talk about the characteristics, this will be relatively more expensive because long-term sources of finance are more expensive, but you will have a lower risk over here. Even the money that you need for a shorter period of time, you have it with you for long term. So there is no worry that you have that I need to repay this money in this much amount of time. So with this, we have covered the approaches towards financing the working capital. Now, we are inching towards the end of this chapter. There are a few efficiency ratios which we learn in this chapter, which will again, be revised in the last chapter, which is chapter number 19. So talking about the efficiency ratios, number one is your inventory turnover. So this is equals to your cost of sales divided by average inventory. Similarly, if you want to work out the holding period for inventory holding period, this will be the reverse of this formula, average inventory divided by cost of sales multiplied by 365. Another thing which deals with payables. So how do you find out the payables payment period? This is going to be equal to average accounts payable divided by annual credit purchases multiplied by 365. And then third, being about the receivables collection, again a very similar formula, collection period So over here you have payables. Now in this formula you will have receivables, average accounts receivable divided by, now purchases happen, that is why you credit purchases happen, that is why you have payables. Receivables are a result of having credit sales. So annual credit sales multiplied by 365. And last but not the least over here is your sales to working capital ratio. So the formula is given in the name itself. This is annual sales divided by your average working capital. So this is how these ratios are there. These are called as efficiency ratios. These are also called as activity turnover ratios, because they are pertaining to receivables, payables, inventory. So these are the ratios which will be there concerning your working capital management. So moving ahead, how do you calculate and interpret these ratios? So there are a few pointers that you should keep in mind when you are calculating and interpreting these ratios. Number one point over here being that there are seasonal factors which affect the values in the balance sheet or the statement of financial position. So whatever you are finding, do not think them to be typical figures. They can be subject to seasonal factors with which there can come a lot of variation. And then your financial statements always have the possibility of being window dressed. So you should take into account that also. One more thing is that the ratios that you are calculating, these are based on past information. So these are about past and not future. This can tell you what happened previously, but this can only give you little information about what is going to happen in the future. Then these are more useful when compared with industry averages. Obviously, whenever you have a comparison to do, then the data becomes more sensible to compare. It becomes more easy to understand how good or bad you are. So if someone has scored 40 marks and the class average is, let's suppose, 35, then you know that company or that person has done well, because the others in on an average in the industry which they operate, they are only scoring 35, but this person has done much better. Last but not the least, if you have limited sets of data, that means you have data that only is for 2 years, then it is better to calculate two sets of ratios based on your year-end figures rather than taking a single set of data which you base on averages. So these are a few points I want you to remember when you're calculating and interpreting ratios. Moving ahead to the very last concept that we have in this chapter, which talks to you about the cash operating cycle. Now, as the name suggests, it's the cycle which tells you about your cash operations. So it's nothing but the number of days between paying suppliers and receiving cash from the customers. Number of days between paying suppliers and receiving cash from the customers. So you also have the formula to calculate this. It's nothing but your inventory holding period plus receivable holding period, receivable collection period. And then less or subtract your payables payment period. And the final answer that you have, this is going to be your cash operating cycle. All right. So this is how you calculate the cash operating cycle. Now, every business should ideally be aiming to minimize the cash operating cycle, because the quicker the business is able to generate cash, the better it is for the liquidity position of the business. Now, the last very topic for this chapter is, the factors which affect the length of the working capital cycle, factors affecting length of cash operating cycle. So the number one factor that you have over here is nothing but the type of industry. So what type of industry am I operating in? That will depend how much money I have to put in as the working capital. If you take the example of supermarkets, their inventories have a low holding period. They have low receivables because, the customers usually pay by cash, or even if they are paying by credit cards, then the companies are quick to pay the money to the, supermarket. They also have a high payables payment period because they buy things on credit from their suppliers. So basically, they have a very low, cash operating cycle. On the other hand, if you talk about a construction company, they may have a very long cash operating cycle because, the production process for them is very long. Constructions can take years of time, and the final money may be received after, at least some part of the construction is done. So that is why you can say that type of industry affects the length of cash operating cycle. Next factor is industry norms. What are industry norms? These are, what is done in the industry. So if your competitors are offering long periods of credit, then, you will also have to give them credit to avoid losing out on business. Another factor over here being the power of suppliers. If you attempt to delay a payment, this could lead to, the supplier demanding cash on delivery. So they will not give you a lot of credit. Then there's one more thing which is called as the terms of trade. What do you mean by terms of trade? What amount of credit period are you offering to your customers? And last but not the least, efficiency of working capital management. So if a business has a weak credit control, they have a lot of inventory, excess inventory which they are holding, so it will lead to an unnecessarily longer working capital cycle. So these are a few factors which affect the length of your cash operating cycle. With this, we are done with chapter number 13 pertaining to working capital management. I hope that this video was useful in your revision. Thank you for watching.